Welcome back, everyone, to another episode on Living Your Greatness. This is your host, Ben Mummy, and the goal of my show is really simple: to learn from those who have mastered their craft of what they do. If you're new to my show, please be sure to hit that subscribe button. Today, I am joined again by Michael Oliver, CEO of Momentum Structural Analysts. So, Michael, welcome back to the show.
Good to be back, Ben.
Michael, I want to start today's conversation to get to know you a little bit better than last time. So I want to start by asking, how did you not only become interested in libertarianism, but also can you share more about your early interactions with Murray Rothbard?
Sure. I was working on a master's degree in political philosophy. I was going to head for an academic career. This would be 1970, 71, 72. And I was down in Columbia, South Carolina, University of South Carolina. And I was writing a thesis, my master's thesis called Anarcho-Capitalism. Okay. That was one of the first times that phrase had been used. Rothbard, Murray Rothbard, who died in the 1990s, is considered, and justly so, the founder of the modern libertarian movement as we know it today. It wouldn't be here had it not been for his writings, which were prolific and so forth. And he is sort of carried forward with the Mises Institute down in Auburn, Alabama. They've been around for since the 1970s. And they're a think tank. It's a libertarian think tank. And they're very influential. In fact, there's an independent rating firm that ranks think tanks in terms of their influence. And Mises Institute's ranked as the 9th most influential in the US. So interesting. But in those early days, I wrote this thesis on anarcho-capitalism, which I've since published it. And it defined the basic concepts of it, but also started with the philosophy of Ayn Rand. Her political philosophy was sort of exempted from that because she was a limited government person. But her basic philosophy I incorporated, and I put Murray Rothbard's economics and politics on top of it. So it sort of changed it a bit. And I merged the two together. They knew each other personally, weren't particularly friends. Rand was fairly, I wouldn't call her uptight, but if you weren't a good friend, boy, you weren't a friend. Okay, anyway, I communicated with Rothbard. He was in New York City. And I told him I was writing this thesis, et cetera. I'd love to quote from his books, et cetera, et cetera. And he gave me permission because I needed the permission because I was later going to publish it. So I got to know him. And I also ran one of probably the country's first anarcho-capitalist or libertarian objectivist / newspaper called The New Banner. And I went up to New York and interviewed Rothbard for that. And it's available on the Mises site. You can go there and you can see the interview. But we got to be a good relationship between us. It lasted a couple of years. But alas, in the 70s, remember stagflation? Well, you don't remember it, but you know about it. Okay. In the 70s, we had what Jamie Dimon says is coming now. And that is we're going to have stagnation and inflation at the same time. And I kind of think he's right, based on my technical analysis, which I don't allow to confuse with my political philosophy. I don't allow the two to necessarily guide each other. Okay. But I knew Rothbard, and the movement back then was literally the libertarian movement. You could probably 100 people, 200 maybe. It was that narrow. And then the LP, the Libertarian Party, which everybody knows about today, that was founded in late 71, early 72. And to show how small that movement was at that point in time, they ran a guy named John Hosper, who was a professor of philosophy at UCLA, I think, for president. And he got, how many popular votes did he get nationwide? And all the ballots, too. 3,500. Okay. So it was hardly what you call a big movement, but it's evolved over the years. And anyway, but I got out of that because I could tell that academic career was going to be pretty stymied, both because who I was, the philosophy I had, and that wouldn't quite fit with most political science or philosophy departments around the country. And two, there wasn't much hiring going on because we had stagflation. Universities were tightening their budgets. And gold was legalized then, 1975, largely due to the work of a libertarian guy down in New Orleans, the National Committee to Legalize Gold. They actually got it legalized. And I think it was anyway, it was signed into law in 75, and the future started trading then. And I got hired by E.F. Hutton in April of 75. So just after gold futures had started trading. And I didn't know a damn thing about markets in terms of, trading or technical analysis and stuff. And I apprenticed under a guy named David Johnston, who then was the chairman of the COMEX, which is where they initially traded gold and silver. And he was chairman during all those interesting years of bunker hunt, in the 70s, where silver went up to $50 and killed the European shorts, and then when it collapsed, it killed bunker hunt. Okay, so but it was an interesting time, and but in 1992, I moved out of brokerage and got into market analysis for sale to institutions primarily, and using my own methodology of technical analysis, which is not orthodox at all. And anyway, we've been around since 1992. We now have retail subscribers as well, but I can tell you right now, and I'm not just trying to heighten things up here, but what we're seeing in the markets and under the surface also in other aspects of our life, politics, not just partisan politics, but the sense of upheaval, the sense of uncertainty out there. And it's not just in the US, by the way, but all these things are coming together in a way that is going to create, I think, historic market movements. It will be quite dramatic, awesome, jaw-dropping, and other events that aren't really being factored into people's sense of what's coming. And we've been arguing for over a year now that there's no outcome to this election that will be copacetic. I don't care who you vote for. If Trump wins, it won't be copacetic because the other side views him as Hitler, and therefore they'll take some kind of action that is not orthodox. Or if he loses, you're probably going to have some states wanting to secede, quite seriously. Texas has already been talking about it, and some other states are intellectually in line with that. But anyway, so a lot of division is going to occur regardless of how the election turns out, but that's not being priced into people's sense of like the stock market, for example. So it's going to be an interesting year, and I think a lot of it's going to be compressed. Not going to spread out over 5 years or something, but a lot of it's going to happen this year. So interesting times.
Michael, I want to rewind for a bit because you did talk about in your earlier years getting part of the libertarian movement, and it wasn't always an easy time, especially the start where it was less popular or looked upon in a different way. So what were the early challenges and experiences like being involved with a movement like this?
Well, as I said, I sort of got out of the movement in 75, and I wrote an article for Rothbard's publication, but that's about the only thing I did involved with the libertarian movement. When the LP was formed, Libertarian Party, I actually wrote an article in my paper denouncing the notion. And Rothbard didn't like it either. He thought it was a silly notion, run for politics, to have power, et cetera, et cetera. It's kind of contrary to being a libertarian. But then he saw a strategic aspect of it, and he later got behind it and enthusiastic about it. But I never got back in the movement as such. I kept in tune with it, and the most recent thing I've done is give a keynote speech at the Mises Institute, talking about what we just talked about, largely my experiences with Rothbard in the early days, and also I got off on the other half of my talk was about what's likely to happen this year. I said it's going to be I'm not a sports fan, but this is going to be the best football game you've ever seen unfolding this year, with all these events colliding. Anyway, the main thing is for your viewers is to take care of yourself, because we're headed for non-normal times. And sort of be on the right side of it. Be aware of what's coming. And I don't mean, this particular investment or that one. That we have ideas on that, of course, but in general, be aware that turmoil is coming, and it'll show itself in a lot of different ways. If you remember back to 2008 and 9, when the stock market had its bear trend, a 50% drop in the S&P over a span of year and a half, late October 2007 through March 2009. Yet, despite the fact that doesn't compare to the bubble we've got now that's going to break, it still hurt people on the street. People who weren't necessarily involved in the stock market, but they got hurt personally. They got laid off. They had to work a part-time job to make up for, et cetera, et cetera. All kinds of personal pain occurred, and they didn't expect it. In fact, the Federal Reserve didn't expect it, so, which is typical. But anyway, we face something now that's far more potentially horrendous. Let's talk stock market right now. If you go back and look at the history of bull markets in the US stock market, like from bear market low to a bull market high, and count the number of years they advanced, and two, what was the multiple gain. And 23 to 29 was a big bull. I think it was like a fourfold, maybe fivefold in the market, but it was only, 6, 7 years, and then it crashed to hell in 1932. And in the mid 70s, there was a peak. You went down and you labored for a decade plus, nothing going on after that peak. Then came the dot-com peak. And if you look at it, it was only really started in late 94 and ended in 2000. So it was like, let's call it 5-year bull market then. And when it peaked, the NASDAQ 100 dropped 82%. That's the dot-com. Which is interesting to remember because we now have the AI argument. We have the AI bubble as opposed to the dot-com bubble. But even then, those who were advocating the greatness to come from internet and how it would change our lives, they were so right in more ways than they could even imagine. And yet they had a bubble because they took price up too far, too fast. And when it finally broke, it just fell apart. And later it regrouped and so forth. But now we have AI doing the same thing. The only difference now is we have a bull market that started in 2009 and made highs in 2022. So that's like 13 years. And then we've extended slightly over the last couple of years to marginally higher than 2022 highs. So we need a 14-year bull market. This is very old. And two, the dimensions are massive. NASDAQ 100 has gone up 17 to 18-fold from its 2009 low. S&P has gone up about 8-fold since its 2009 low. There's no prior bull market bubble that matches the dimensions of this one. And it's not because the economy is so great. That's not what drove it there. If you look at an M2 chart of the Federal Reserve money supply, and you can see why. They printed the money like crazy. And they lowered rates to effectively zero and kept them there longer than, except for the last 2 years. The rates were effectively zero. So that's like fuel in the tank of the car. And so the bubble just lasted and lasted. So the problem is when that breaks, it's a bigger bubble than ever. So the real world in the street consequences could be worse than what we saw in 2008 and 9, for example.
And so what are the potential consequences that could happen when, a bubble like this bursts?
Well, aside from already the public feels sort of uneasy. And I don't mean because of the politics, but because of the day-to-day economics. Okay. Yeah, there's a class of people that are wealthy and still spending their money and having a good time. They don't care. Everything's good. Having travel trips, go to Europe, et cetera, et cetera. But most people from middle class on down, say the majority of the population, is hurting. And it's because of the money growth has also spawned growth in the commodity sector, which was vastly, vastly underpriced. If you look at the Bloomberg Commodity Index, for example, which is a pretty well-balanced index of the basic commodities of life, it was at 237 back in 2008 and 170 back in 2011. It got down to into the 50s in late 2020. It's priced off the page, okay? And we had a breakout in October of 2020, and it shot up for a year and a half when the war in Ukraine started. Basically, commodities peaked, by the way, at that time. They didn't go up because of the war. They were already gone up. And then they pulled back, but now they're starting another move up. So this Fed concern about, quote, inflation, as they narrowly define it, improperly defined it as far as I'm concerned, is they've seen it toned down. But our measurements of the Bloomberg Commodity Index say, no, it's starting again. The next leg up is beginning. It began a couple months ago. And it's not going to be explosive at the outset, but it's going to show itself. Probably well in this year, it'll show itself. Again, pinching people, day-to-day reality. And so the Fed's facing this issue, we're going to, quote, fight inflation, again, as they narrowly define it. And yet they have another mandate, which is the unemployment issue, which is getting bad quickly. In fact, it's been bad for 3 or 4 months, despite the top line number, when you look inside the employment data, it really is weak. It's all government employees, hospital home care workers, hospitality workers. It's not the basic core industry groups that's having growth in jobs. They're flat. And now we're starting to see downticks in job growth. And I think the Fed's going to try to respond to that, meaning this is what I think gold knows and knew for the past few years, is that when this bubble breaks, the Fed will come in and try to save it. They always do. 2001 to 2002, they printed money and they cut rates like hell. 2007 through 2009, they cut rates like crazy and printed money, QE, et cetera. This time they'll be faced with that other mandate, the unemployment issue, which is contrary to their tightening of, quote, inflation. Well, the ECB just cut rates today. That's one of the team members, Federal Reserve, ECB, and the Bank of Japan. They cut rates. And I think probably after tomorrow's report on unemployment, they might find some data points there that they can say, oh, now we have justification to begin to cut rates. And that is indicating to me that they're concerned about what's coming. That's why they cut rates. Anyway, I think this stuff's going to hit the fan this year.
Do you believe that we are in the biggest stock market bubble in history?
Yeah, no, it is. You measured by number of years up, and two, the percentage gain from the bear low. And so we're like triple the age of the other ones and quintuple most of their gains, okay, of those comparable bull markets that we, in hindsight, call bubbles, right? .com bubble. It doesn't compare to what we've got now. And now we've got a market, if you want to talk markets, the stock market's being led by the front end symbols in the S&P 500 and the NASDAQ 100, for example, where five or so stocks constitute 30-40% of the index. All the rest of them don't matter. And that's narrowed and narrowed and narrowed. Now you got NVIDIA. Used to be there was like 7 or 8 that did pretty well. And now most of those former leader stocks are just sort of floundering. They're not breaking down, but they're certainly not exploding. And we've narrowed the leadership down to NVIDIA, which is like a bubble stock. Not that it's invalid, not that their notions of the future of AI are invalid. It's just that they price themselves off the page into the realm of uncertainty. And when that happens and something turns down, it often finds no support because nobody knows where the hell to buy it. They've already bought it, And so you get crash-like events. And anyway, that'll be a factor that we're watching. But in general, there's so many attributes to this stock market that say, nah, don't count on this lasting. And when it turns down, it will be painful.
I know you are very bullish on precious metals, right? And that's one way that investors of all kinds, of all ages, of all experiences can protect their wealth and hedge their money. And I recently had Alistair McLeod on a couple weeks ago, and he stated gold is money and everything else is credit. So I'm curious, before we even explore precious metals, like hearing that statement, like, is there anything that you want to add to that?
No, he and I share that view. He's fundamentally oriented, and I'm technically oriented, but we just entered a few months ago in silver, gold, and the gold miners, which are vastly underpriced asset category. I mean, off the page, underpriced. We just entered a phase of the ongoing bull market that began from the 2015 bear low in gold. Gold then, back in 2015, December, was trading around 1,050. And it took it till, recent few years to get up over 2,000, meaning double. But if you go back and look at the history of gold bull markets the last 50 years, the number of eightfold moves, there's 2 of them. Okay, so it's almost normal. Eightfold move would be $8,000 gold if you just replicate. But we have events and dynamics out there on a fundamental basis that are far more potent, earth-shaking than anything we've ever had before. And I think gold knows that this stuff's coming. And therefore, those who seek real money are buying. We don't call them, by the way, precious metals. We call them monetary metals. For instance, platinum is not behaving at all like gold. And yet it's lumped in as a precious metal. It's laid on the ground for the last couple of years, while gold doubled and so forth. But the monetary metals, we don't just recognize, some American investors don't just recognize that fact, but a lot of the world does. India and China are buying the heck out of the gold market and silver market. And so a lot of that part of the world is buying it and going to real money, and which means they'll have better stability financially than we will. Because there's no doubt, and gold knows this again, that when you get into a panic downside, there's certain asset categories that the Fed doesn't want to go down, stock market being one, although they'll never admit that, but their history proves it's the case. When that thing goes down, you get real world effects, like unemployment data really starts to jump up bad. Other data points start to industrial production, so forth and so on. They tend to follow the market down. When that happens, the Fed will go the other way. So the last couple of years of relative tightening will reverse. They'll have to. Otherwise, they'll have a panic. And even when they reverse, it won't stop it. It didn't stop it in 2000 to 2002 when they started cutting rates drastically. Even market collapsed anyway. 2007 through 2009, the real estate bubble. In fact, they cut rates in September of 2007, mid-month, and the market peaked the next month. After they first cut rates in several years, they finally cut rates, and that was the top. And if you shorted when the Fed started cutting rates, you nailed it pretty well, and the market collapsed for 2 more years. So everybody right now who's all cheering the notion, oh boy, the Fed will cut rates, that'll be good for the market, so let's buy some stocks. Watch out what you hope for. And go back and look at history, because it means the Fed's panicked. And when they panic, they go monetary crazy. They expand the money supply more, they buy assets, increase their balance sheet, anything and everything they can do to save the situation. And that increases what? The monetary degradation of the dollar and other fiat currencies as well. They degrade as they inflate them, so it buys less every decade. When I was a kid, a loaf of bread cost about 20-something cents. Right now it's about 3.80, I think. Okay, what do we have, a wheat shortage? No, it's the degradation of the money unit ongoing. Every decade, the money supply almost doubles. Almost, regardless of whether it's a recession in that decade or not, it means the money supply, the buying power of the thing in your wallet diminishes by 50% every decade. So if you bought a stock at $10 and 10 years later it's 20, you're not making any money. Okay.
And so, Michael, knowing that information that you just gave, what is your current outlook right now on gold and silver, especially in relation to their historical performance and current market conditions?
Yeah, that's sort of a fundamental question, and I'll answer it technically, though. The past 3 years of action after gold doubled from its 1,050 low to a 2,070 price high, it did that in the mid-2020 year. That's when it made that high. And since then, it went up to over 2,000 again and again. And finally, we're now burst up to 2,400, 2,400. So not only has price blown out that ceiling that prevailed for the last 3.5 years, but our momentum metrics of gold, when we measure, for example, I don't want to get everybody messed up in the head here, take a monthly price chart of gold, the bar chart, high, low, and close, and you plot it. That's a price chart that everybody sees, okay? Oscillate that against, let's say, a 3-year moving average. So notice, where is this month's range in relation to the 3-year average for this year? And you plot it on the oscillator. It's so much above, so much below, whatever. And you get a totally different chart than if you look at simple price chart. And by our metrics, in March and April, gold, silver, and the miners have broken out of that holding pattern that they were stuck in since 2020. Usually late in a bull trend. And we've been going up since 2015. So it's, 9 years or so already. You go back and look at the peak in 1980. The gold hit $875, silver hit 50. And that had been going on since the mid 1970s. Gold was $35 an ounce. Silver was probably $5 an ounce. But in the last year of that bull market, it went berserk. The multiple gains was like everything that occurred before was trivial compared to what happened literally not in the full year, but even the last 3 quarters of 1979. They went off the page. Silver went from like $20 to 50. And it's done this before where it goes up to 50 from a level that's under 10 even. But right now, we've had the momentum breakout that tells me that holding pattern that everybody's sort of gotten used to if gold runs up a certain level, it gets quote overbought, by, let's say, looking at RSI or MACD, these things on your computer, the little momentum metrics. We call them wet noodle indicators. But the norms that we've seen for the last 3 years are abnormally narrow, abnormally quiet. So the fact that gold gets overbought and half the gold bulls out there say sell it because it's overbought. But by the standards which they're used to, they've been spoon-fed this non-volatile market for the last 3 years. And they think those rules still apply. They don't. We're in the acceleration phase. We're in that phase of the last year of the bull where it goes berserk. And it prices in all the things that have been in its gut all along, knowing they're coming. It starts to see those things develop, like, for instance, the unemployment situation deteriorate, therefore the Fed reverse policy. Gold knew that was going to happen. And it priced it in. So now we're getting to the point where I think you start to go vertical. And you can take all your technical metrics that you're used to looking at, throw them out the window. We're in a new reality right now.
So talk to us more about this acceleration phase, because I know Eric Sprott is a huge fan of your work.
What I'm expecting, I'll talk personally, and we put this in the market ladder as well. The relationship between silver and gold at those times, tail end of those bull markets, accelerates favoring silver to the point where it's almost, it's a joke. It just so outpaces gold by so much. It's, gold's going up and it's going up dynamically, but silver just goes ballistic. And it did that in twice before in the history of the silver market over the last 50 years. In the last year, like in 2000 and 2001, the gold market was bottoming around $250 an ounce after having been up to $850 in 1980. Okay, so 20 years later, it's at $250, basing. Silver was basing. Started a new bull trend. It didn't peak till 2011. We're talking 10, 11 years. So we're about that old, okay? And in that last year, silver went into an acceleration mode where not only could you just see it on the price chart, where gold just it started to explode as well, but silver just went almost off the page in the way that it behaved. And what we do is we measure the relationship between silver and gold, and also the gold miners and gold. And in this pullback that we've had, this range-bound situation since 2020, where we mucked around, and silver and miners actually staircased down while gold went sideways, they underperform gold. So if you were a long-term gold investor and got in at the right spot, like February 2016, which is when we pounded the table, gold was $1,140, okay? And you've been sitting on your position where you got bored to death for the last 3 years in gold. But in the miners and silver, you actually gave back some good profits. But the action of not only the momentum of those markets has broken out to the upside, saying, okay, trading range over, we're going dynamic. But the relationship between silver and gold also broke out. So you could plot that technically, and the miners and gold. So as bad as they've been underperforming over the last 3 years, they've now shifted to outperform. So if you're deciding at this point to say, well, I need some position in that type of monetary metals, whether the metals themselves or the miners, we strongly suggest your emphasis should be silver and the miners. Gold's the mama, but gold's not going to perform percent-wise what silver and the gold and silver miners are going to do on a percentage gain. That's where I would be focused and where I am focused.
I appreciate that answer. And are there any other commodities that you feel investors need to pay close attention to right now?
Well, in the explosion, we call it a commodity explosion back in October 2020. Bloomberg was coming up off of its low, and it got to $70 and went to 140 early 2022. During that move, energy was one of the best performing sectors, oil, natural gas, okay, in terms of percent gain. And they're, hefty component within that index. But everything went up then too. You could throw a dart at almost any commodity and it went up. So it wasn't based on specific fundamentals for that market. It was based on money flows going into an asset category that was priced off the page, which is dirt cheap. And it went into that category. Now, it didn't go with gold. Gold had already doubled by 2020. Well, the commodities didn't bottom till 2020, and then they exploded. But this time around, we suspect that other than energy will lead this. So energy will join in. I don't have any doubt of that, oil and natural gas. But I think the grains could shock people. And already by our metrics, wheat's already broken out. Well, this is also, it's as important as is the price of gasoline you're pumping into your car. Everybody's all concerned about that. You get concerned about the price of the stuff on the grocery store shelf. It's got wheat in it, or whatever. And corn and beans look like they're close behind soybeans, and rice as well. It's other part of the world. It's the basic food stuff. So it looks like food commodities could be the more painful upside in this Bloomberg Commodity Index next wave up. And that's going to be painful for the average person, the family budget. So anyway, that's where I would look. But basically the stocks, if you wanted to put on a quote market neutral position and be short the stock market at some point, like S&P 500 or NASDAQ 100, and then long an equal amount of stocks to balance it out. So you're market neutral, right? You've got a balanced portfolio. Being long commodity related stocks, whether they're grain production companies or they're fertilizer companies or they're oil industry or they're copper miners or base metal miners or the gold and silver miners, that's the place to be if you want to be long stocks, because they have not behaved like the stock market. They've not created a bubble. And if anything, they're ready to engage their next leg up. And so that would be a place to be, is commodity related stocks.
What is one of your biggest fears that you have right now?
Actually, I don't have fear. The reason I don't is, one, I could see it coming. Gold could see it coming. It's a wise market. It's been around 3,000 years after all. It's not like a lot of markets today have been around, 100 years or 50 years, et cetera. So it knows things. But I could anticipate it coming. In fact, in many interviews and reports we've issued, we've pointed this out. And I'll hit you with some hard data. University of Virginia Department of Politics back in October of last year did a poll of Biden voters and Trump voters. We're starting to hear this now in the general press, but they asked very potent, pregnant questions like, if the other party, the other side wins this election, would secession be justified? And it was like a large double-digit percent on both sides said, yeah, blue states should secede or red states should secede. The other one was, if they win, is violence justified? The numbers, I forget the exact numbers, but I think they were well over 20% in each case. So we're talking numbers that we've never seen before in terms of the average guy, not somebody running through the street, but somebody who might be running through the street. But there's a sense of great unease. And it's caused by all these factors we've been talking about, the day-to-day pain of paying for things, being in debt, seeing no way out of it. And God forbid you get laid off. It's a disaster. And the 1%ers are going to feel pretty bad too when their bubble breaks. So, but there'll be real world implications in the street type emotional things. And to some extent, as a libertarian, it's inevitable. In that speech at the Mises Institute, I used this phrase. I said, Ayn Rand would, we're entering part 3 of Atlas Shrugged. And that's the part in the novel where all of a sudden stuff starts to happen. Disastrous things start to happen. Unexplained accidents, logistical problems of shipping grain or metal, train wrecks, even a bridge collapse. That was in part 3. So in other words, where everything seems to be getting worse, and suddenly it just gets real bad, real quick. And that's the tail end of that novel. And I think Murray Rothbard would also understand what's going on and say, yeah, this is inevitable. When you have a government that controls your life to the extent that even democratically elected governments do, practically tell you when to brush your teeth. Not quite yet, but that creates errors. It takes away human individuality, volition. Instead, you're pursuing collective goals as opposed to your own, and you're shaped in that direction. Well, it creates economic accidents. It creates, and these things finally come to a culmination. And when they do, it's painful because it's like, I guess you have a baby, it hurts, right? So you give birth to something new. And there's an interesting guy down in Argentina. I'll give it as an example because he sort of represents in a microcosm what I'm talking about. Argentina has been run by 2 political parties for decades. Basically a socialist direction. Didn't matter which party, back and forth, back and forth. Argentina used to be the 8th biggest economy in the world about a human lifetime ago. Now it's, way down the scale. It's suffering from hyperinflation and all kinds of other economic problems. And so Javier Milei was a quote anarcho-capitalist. He's written economic books too, so he's an intellectual. He ran basically on his own, didn't really have a party, and he wiped them out, the two parties. He derailed the two-party system, and he got a huge amount of youth vote. Now, what does that mean? Well, admittedly, he looks like a rock and roll star, and he's very dynamic. Okay, so you watch him, it attracts your attention. But he is an intellectual. But the point is, I think what he appealed to was the sense of uncertainty, the sense of things aren't working the way they should. Tear it down. That sort of emotion. Not that all the people in the voting public could pinpoint why it didn't work. They just knew it wasn't working. Let's get something new. And he offered him something new. So among the things he's done is he started selling off chunks of the government. Literally. And there's one chunk of the government that regulates, just like, in the US, we have things like this too, and elsewhere, regulating rentals, home rentals and housing, so regulations, make sure it's done right. Okay. And the problem is that the average or the lower income people in Argentina couldn't afford housing. Well, we're starting to hear that here, okay. Couldn't afford housing. And so, apartments were just too much. By dismantling that portion of the government, within months, the housing prices, especially at that end, dropped 20%. So already he relieved some of the pain. And it won't be easy for him. And I wish him well. But we live in that kind of time where people have a sense of chuck it. Not quite sure where they want to go, but just chuck it. Let's get that done first, and then let's figure out what might be right. And you see some of this in Europe too, by the way. There's some parties over there that are emerging sort of surprisingly to many European political analysts and rising to power, in fact, not just being a minority party getting more vote, but actually becoming the chancellor or whatever. In countries you wouldn't expect that to be happening. And I think it's also partly due to that sense of unease, that undefinable, but there.
No, I appreciate that answer there, Michael. And it makes me think, like, with increasing distrust in like the government, how do you see this affecting like the future of cryptocurrencies like Bitcoin compared to traditional safe haven assets like?
Well, Bitcoin, we've been analyzing it since it started in the futures market in 2017. And we've called all the major moves in Bitcoin very well. It's documentable. Okay. We got bullish back a couple of years ago, 2022. It was down in the 20,000 zone, even lower. And, it's gone up to 70, made new highs above the earlier highs, just around 70,000. And right now we're 71,000. But it's behaving almost exactly now like an overlay of the NASDAQ 100, meaning Bitcoin is not moving like gold as a quote alternative currency to paper assets, but it's moving more speculatively, more like it looks like almost a tech stock. And so that's troublesome. And it's been in an uptrend. We define a momentum uptrend. I've used in fairly long-term metrics, but we got bullish in 2022. And frankly, all those metrics are still intact. So it's still in a positive trend, but it can't sneeze. And I think it will. You can't go back down like to 60,000 again. And we've been down there recently. You can't stall up here in the 70,000s and roll over even that much, because you'll blow something. You can't see it on the price chart, but our momentum says you just blew your structure. The bridge in the river Kwai is coming down. Okay. And it's behaving like NASDAQ, which is quite interesting. I don't think crypto can compete with gold. And one of the reasons is gold is more personal. It's hideable. It's not so measurable by the government. And when you have crypto, it's computerizable. It can be watched. And the central government, some governments already ban it, but others are dismissing it, saying, we got to control it because it's criminals use it for laundering money. Or that recently they had a study that because of the crypto mining, that was causing excess electrical use. So bad for the ecology, and so forth. They'll come down on it if it becomes too competitive to their own paper currency. And if you go on Google, I think it's going to run into problems. I don't think it's going to follow gold up, technically. But when you go on Google and type in, Bitcoin accepted where, you'll find all kinds of stores that you didn't imagine will take Bitcoin, big name stores. So imagine if it actually got popular enough where people used it. Let's say 10% of all daily day transactions, grocery stores, et cetera, were done by crypto. In effect, you're seceding 10% of the Fed's power from it because they control the money, okay? They determine how much it is and what the price of it is, I mean, and the interest rates. If all of a sudden you take 10% of that out of their control, then you've reduced their, quote, power. And therefore, they don't have the control over society and the society's money that they had before, same with the ECB and so forth. I don't know if we'll ever reach that point because, frankly, I think Bitcoin's going to crumble with the stock market. But that alone would cripple and restrain Bitcoin. In fact, there are a lot of governments around the world that are already doing things like that, trying to restrain it because they know it's competitive to their monopoly over fiat money. But Bitcoin does have the one virtue. It's not infinitely expandable. You can't at a moment's notice say, okay, we're going to double the money supply. It has its own market value, and the supply of it can't just be instantly increased rapidly. So that is a virtue, and it can't be decayed in terms of its buying power. What can decay it is if it goes down in price. But anyway, so I think it's that argument. It's competitive with gold. No, I don't think so. Not what's coming. I don't think it'll be competitive.
I appreciate that answer, Michael. And I want to shift gears here in terms of investing rules that you stand by, that you believe make a great investor. Last time I had you on my show, I asked you about, what makes a great, trader. Now I'm looking more in terms of investing. What makes a great investor?
Well, you want to get in the right time. You don't want to chase a trend like people chasing tech stocks now. If that's an initial position, for example, or it's a lunatic action. Your risk reward is shot. You've already had great reward if you got in at the right times and places. But if you got in late and chasing something like this, when this beast turns, it can wipe you out so quickly that what might have taken 10 months might take 10 days to erase. Now, I'm literal about that. It's demonstrably historically provable. And I think this bubble will do that as well. So you don't get in late. If it's late, find something else to do. If you want to buy stocks, fine. Buy commodity-related stocks, grain-related, fertilizer companies, which had a great move in that 2020-22 move and then had a big pullback. So I think they're ready for another one. Buy the gold silver miners. They're priced off the page. Both you can measure like GDX, a very popular ETF of gold and silver miners, and look at its price in relation to gold historically. It's a percent, what's the price of GDX expressed as a percent of the price of an ounce of gold. And you could plot a chart. Well, it's dirt cheap. It's just it's like dead when you look at that spread chart. And it's broken out now. We think that spread relationship is shifted. There's a category that you can buy as an investor now. I'm not talking about trading in and out every 2 weeks, where it's basically coming up out of ground zero. Now, gold isn't. Gold turned up by our metrics above $1,100 back in February 2016. And so far, that trend has not been broken, annual momentum trend. But the gold miners have just resurrected themselves. And there's some major fund managers like Druckenmiller, who back in mid-February, several months ago, bought a bunch of gold miners and dumped a bunch of big tech stocks in his portfolio. And like one of them was Newmont Corporation, which is the biggest gold miner in the world. And it was trading then around $31, $32. It shot up to 42. It's a huge percent gain since mid-February to the present. So it was a wise decision. And no doubt many people back then at other competing asset managers probably chuckled, said, what an idiot buying gold miners. Boom. He could see value. It was priced off the page. And therefore the risk reward is appropriate. Now, if you're using leverage, there's different rules you have to do, and especially if you have call options that aren't long dated and are very speculative, you have to be more concerned about the short term. But if you're an investor, I'd be looking at just silver bullion and the gold and silver miners. And I think they're basically extremely low risk compared to what the potential is on the upside. And I can't find categories like that right now anywhere else that have that potential dynamic with the risk being so low.
And Michael, what are investing principles or lessons that you have learned over the years that you want more people to know about?
Well, contrary opinion is one thing that's quite popular with some people, although they're ignoring it now. That's when everybody's chasing something, the mob is chasing. Sometimes the mob can be right for a while, and you get swept into it. So even if you're a wise investor, say, I can't chase it with the mob, chasing this little group of stocks. That's idiot stuff, But then you get swept in because it doesn't break down. You feel like you're a dummy. Gee, I should have gotten in there. My neighbor did, and he tripled his money, But continue to have that wise thing in the back of your head, because the problem is when things really do break and they're bubbles, we can define them as bubbles via certain metrics. When those things break, they can come apart so quickly that you don't have the time to think your way out of it. It's just night and day. And that's what we're facing, I think, right now, is that risk of the night and day, especially if the Fed cuts rates soon. Again, using an historical example, 2007, if you waited 4 weeks and shorted the market, you nailed the top tick after their first rate cut. And in 2000, the market was topping. And in January of 2001, barely off the high, they started cutting rates aggressively. If you shorted then, you you caught the whole bear market. So I think we're at that point now. And I think a lot of people are going to get hurt by what they've been doing for the last year or two.
Michael, one last question that I want to ask you is, what is one question that you've been wanting anyone who interviews you to ask you?
You've already asked some good ones about, what's coming in the broader view. And I think that's the important thing I can offer other than market stuff is I think we are philosophically, politically, socially, in part 3 of Atlas Shrugged, we're compounded error of decades before and decades before and decades before, errors that were put off, restrained, printed money to pave it over, et cetera. Suddenly it gets exposed, and it's a shock effect because things start to move very quickly. And so you getting me to talk about that was, I think, very important. That's the one stress point I would make, is that it's going to be unusual here. And regardless which side you're on, prepare for it. Take care of yourself, because it's not going to be normal anymore. And be aware of that.
Well, Michael, I want to take this last little bit of time, to really thank you for being here today. Thank you for your knowledge, your wisdom, and just sharing all of your lessons that you've learned over the years.
Thanks, Ben. Appreciate being on here.
Likewise.
I like the breadth of your show too.